What's up, guys? Another episode of Chalk Talks with Coach B. Today, I want to get into some options basics. We're going to start with breaking down exactly what a call contract is. And then in the next video, we'll move into what a put contract is. Understanding, the basics of these contracts, I think is important before we start talking in some of the more intricate details, and also before we start talking option strategy. So I wanted to start here. In terms of call contracts, I like to think of option contracts as basically like a coupon. Essentially, it's a coupon with an expiration date so that you could buy 100 shares of a stock at a fixed price, which is also known as the strike price, right? So, for instance, you might buy a coupon to buy a stock at $15 in January, right? And, so when January rolls around, if you hold that coupon, you hold that contract, you have the rights to buy that stock for $15, even if it's trading at $200, even if it's trading at $18. The stock could be trading at $6, and then you wouldn't want to use your coupon, but you still have it. You still have that option, and that's what a call contract is. So there's 4 basics of every contract, right? First off, thing you should know is the quantity. Every single call contract accounts for 100 shares. All right. So when you look at a call contract, one contract equals 100 shares. Second is the strike price. That's the amount on the coupon. That's the amount that the coupon holder can buy those shares at. Okay. So there's always going to be a strike price. Next thing is the expiration. All these contracts have an expiration date. That's the date at which, after that, the contract is no good. So anytime between now and the end of the contract, you can exercise, basically, which is to buy. You can go in and buy those 100 shares at any moment between the day you buy it and the day it expires, but you got to do it before it expires, okay, or at least at the expiration date. And finally, there's the premium, and that's basically the cost of the contract. So, yeah, you have the strike price, but there's also a premium. Whoever's buying this contract is going to pay the seller a fixed amount of money for that. Basically the coupon isn't free, right? The seller needs to make some money too. And that's what the premium is. So the seller's basically going to say, yeah, I'll let you buy my shares for, this strike price down the road, but you're going to pay me today. And that money for the premium, they keep that. You never get it back. That's their incentive for selling you the coupon. So anyways, a lot there, but let's break this down in an example. Okay. So I'll be the seller. You're the buyer. Let's say I own 100 shares of a stock, and that stock's trading at $10. That seems to be my favorite amount that I always use. But anyways, you're interested in this stock, and you think this stock's going to go up to $20 by let's say the end of the year. Let's just say February. You think by February this stock's going to be trading at $20, and it's $10 today, but you don't really want to spend $1,000 today on buying, 100 shares, or, maybe you don't have the $1,000 today and you're going to use this as kind of a down payment, whatever it may be, but you don't want to spend that $1,000 today. But you really like this stock and you really want to have the ability to kind of get in on this movement because you think it's going to go up before February. It's going to hit 20. Okay, so instead of buying those shares for $10 a piece today and spending $100 or $1,000, you can go buy a call options contract. So basically first, and that's going to give you the rights to purchase these shares at a later date. So how would you do it? Okay, well, I think February it's going to be worth 20. Maybe I say, okay, I want the rights to buy this stock at $12 in February, right? So I would buy a February expiration. I would buy the $12 strike. That's going to give me the rights to buy it for $12. And now I just need to see what the premium is. So I go in and I go to the seller and I say, okay, seller, I want to buy this call contract. And they say, okay, it's going to cost you a premium of $25. All right. So 25 cents per stock times 100. So $25 premium. So again, let's break this contract down in the basics. The quantity is 100 shares. Strike price $12, expiration February, premium you're going to pay today is $25. You're going to pay that to the seller today, and the seller's going to keep that. Okay, so now when February rolls around, as the buyer, you now have the option to purchase these 100 shares at $12 each. All right, you already spent $25 on the premium, but you have the option to purchase them for $12 each. So that's going to cost you $1,200, right? And this can go a couple different ways. If the stock's trading at $8, you're not going to buy those 100 shares. Why would you? You'll be out some money, right? I mean, the 100 shares of this stock's only worth $800, and so why would you spend $1,200? So that's fine. You just let the contract expire. You lost $25. Your risk was $25. It's fixed. That's it. You're not going to lose any more. You're done. That's all you lost in the total transaction. Now, on the flip side, let's say the stock's trading at 20, like you thought it would be. You'd be buying those at a discount, right? I mean, who wouldn't want to buy a stock at $12 that's trading at $20? That's like an $800 profit minus the 25 you already spent on the premium, so $775 profit. But still, I mean, it's a winning transaction for you. From the seller's perspective, if you decide to buy or exercise the stock, they have to sell it to you at $12. Even if it's trading at 20, even if it's trading at $100 a share, they have to sell it to you at $12. So you're going to spend $1,200 and you're getting those shares. No matter what the stock's trading at, you can go in and buy it. Then you could turn around and just sell the shares if you wanted to, or maybe you want to keep that stock long term. But regardless, they have to sell it to you for the strike price of that contract. All right. So from the buyer side, it's a fixed risk, high reward scenario. You know what you're risking. You're only risking the premium. In this scenario, we paid $25. Your upside is unlimited. I mean, the stock could be trading at 100, 200, might be trading at $50, whatever. But you have the option to buy it at $12 a piece. And if the stock's trading below, whatever, you lost it. Now, the seller, on the other hand, they're assuming much more risk. They're responsible to deliver that stock at $12 per share regardless. If you decide to exercise it, they need to come up with the shares. They need to give it to you for $12 a piece. Okay. So I hope that all makes sense. That's the basics of a call contract. But before we finish, I want to go over and look at an actual options chain and go over those 4 basics just so we can have a clear understanding and break down the break-even pricing. So let me see if I can pull this up. Now, there's much more that goes into buying an options contract, but I just want to show you how to read a chain, okay? So right now we're looking at Disney, ticker symbol DIS, and it's trading at about $172. So all options chains are going to look different, but they all should contain the same information. Right now we're looking at Thinkorswim, which is a software of TD Ameritrade. But if I go down here and let's say I want to buy the coupon, the options contract, to purchase Disney shares in June of 2017. So I'm going to come down here to the expiration date of June 2017. Okay, so now we're looking at this option chain, and I want to go and be able to buy Disney in June 17th, 2022 for $200 strike. Okay, so I come down to this $200 strike, and there's our strike price. That's the coupon amount. There's our expiration amount, okay, or our expiration date. So now we need to find out what the premium is, right? So we come over here, and there's 2 numbers. There's the bid and the ask. Now, in my previous videos, we talked about the bid is what buyers want to buy this for. The ask is what sellers are selling it for. So typically, let's just say we're paying the ask $7.80. Now, remember, it's times 100. The quantity is always times 100. So $7.80 times 100 is $780 that I am going to pay today for the rights to buy Disney at $200 on June 17th, 2022. Now, when this comes around, let's just talk about this. Let's talk this through. So in order for this trade to be profitable for me, my break-even price on this trade would need Disney to be trading higher than $207.80. Why? Because I already paid $780 in premium, $7.80 per share in premium. Okay, so yeah, why would I go in and spend an extra $200 to exercise this and buy these shares if the stock's trading at, 205? I basically lost $2.80. I want the stock to be above 207.80. That's when the trade becomes profitable for me. Now, so for $780 today, if the stock's taking, let's say Disney's trading at $300 a share, I'll go put up the extra 20 grand to exercise these 100 shares. And, now I'm in a profitable trade. If Disney's trading at $150, down the road, I don't have to exercise. Doesn't matter to me, but the seller, he got my 780 and he's done. He's out. He's got it. He's only on the hook to deliver these 100 shares if I decide to exercise and if this stock is trading above 200. All right. So that's it for today. I just wanted to kind of go over the basics, kind of how to read a chain, just so we could look at it like right there. Every chain is going to have an expiration date, a strike price, and a premium. And that's going to be, either you're going to pay the bid or the ask or somewhere in between. But those are the basics. There's so much more that goes into it. What affects, options contracts? What makes the premium exactly what it is? What affects that price? There's so many other things, the Greeks, and we'll get into a lot of that as we continue to go on. But I wanted to start somewhere. And, again, if there's anything I missed or anything that you have more questions about, or even any other future topics you want me to go over, please leave it down in the comments. Also, please hit the like and subscribe button to support my channel. And come check out my live stream every morning from 6 a.m. to 8 a.m. on the West Coast. That's a half hour before the market opens. We talk stocks. We go over other hot plays in the market. I answer questions. I ask questions to other people. It's a great time. Really love to see you there. Anyways, have a great day and look out for my next video on puts.